All right. Welcome to another week of the Educated Home Buyer Live. Josh, you need to unmute yourself. Coming in hot this Wednesday to update you on everything that's happening in the economy. We had a big announcement today with the Fed, which we're going to dive into in more detail. We're going to answer your questions live as we always do, and we're going to update you on inventory and all of that stuff that's happening around the United States. But before we do that, we want to welcome Mr. Josh Lewis back to another week here on the Educated Home Buyer.
Well, Jeb, before we're getting ready to come on, before we realized that we needed to actually come on here, I was about ready to tell you that the numbness wore off just in time for me to talk to you and the kind folks watching at home. But unfortunately, that has brought the pain of the drilling they did in my mouth today.
Yeah, so Josh had a cap a crown put on rather, on his. And I asked him, I was like, hey, are you going to be okay? He said, yeah, I'm tough. So here we are. A couple hours later, he's here to deliver what we always do. But Josh, let's start tonight with the big announcement from the Fed. So the title of this episode was "The Latest Fed Cut Will Have No Impact on the Housing Market," with the idea that the Fed was going to cut 25 basis points today, which is exactly what they did. But they came out and gave us what we expected to hear, but yet the market went the other direction. So let's pop this in there. We can prop it in there too.
Pop it like it's hot.
Yeah, we'll prop it like it's hot here with the 50. So basically this shows that the Fed cut the Fed funds rate by 25 basis points. As we've discussed previously before, this is not a direct impact on mortgage rates. So actually what happened was the Fed cut 0.25%. We probably saw rates go up about 20 basis points, Josh. Almost the amount that they cut, they went the other direction. So I don't know if you want to dive into that right now or just look at the slides here and dive into it.
It was a perfect example, Jeb, and the way the media works and the headlines work, what the consumer hears is they just hear the cut. Have a borrower in your homeland, North Carolina, got a property under contract this weekend, and we talked about locking it yesterday. And I went back today and said, hey, terms are a little bit worse. And we go through it, and he goes, what happened? They were supposed to cut, and they cut. Why did rates get worse? So it is a perfect example, and today is the best example of it, of buy the rumor, sell the fact. So when the market thinks something is going to happen, they start pricing it in. And when it happens, they're looking to what's next. And that is what moved the market today. It wasn't what they did, because what they did was a cut. So that would mean lower rates. That was already priced in. They took away future cuts, and the market did not like that.
And one of the reasons they did not like that, Josh, is the dot plot, which essentially shows where the Fed is kind of as a consensus, I think it's 15 of them making decisions or so, where they are as a group with future rate cuts, right? So what we have here is we have previous expectations or projections rather of what the Fed was going to do, and then the changes in those expectations based off today's meeting. And that is really where I think the biggest hurdle lies in what we saw today is the fact that, instead of being in the low 3% range with regards to the Fed funds projections, they're looking at being in the high 3% range with projections. So elaborate on that a
full 3/4 point difference. That's a big difference. The thing to know, so the Fed meets 8 times a year. 4 of those meetings, they do these summary of economic projections. The thing to know, these are volatile. These are human beings, smart human beings with some of the best data in the world, but things change really quickly. 90 days ago, Jeb, we were looking at this and we were getting a 50 basis point cut. We got the last set of dot plots saying they're going to cut 100 basis points next year, which now we're down to 50 basis points of cuts that they're expecting. And you were looking at it going, rates are going to go through the floor. And what I was telling you, you were working from home today or out in the field, and I've got CNBC up here, and they brought a steady stream of experts in there talking about treasury yields on the 10-year going to 5 to 6%. Which, if you had turned on CNBC yesterday or last week, there was absolutely no one talking about that. So 90 days ago, everyone's talking about how low they're going to go. Today, we're talking about how high they're going to go. The truth, as always, is going to be somewhere in the middle, and it's going to be data dependent.
Yeah, and so with that, let's take a look here at the changes in the actual Fed announcement, if you will. Very little changes. In fact, nothing really other than the fact that they cut interest rates by 25 basis points. They did change the language a little bit after that, but nothing really to make the market do what it did, right? So with that, let's take a step further and actually go over Powell's comments, because I think that is important in what he's actually, the context, right? It's not just a headline. It explains a little bit more.
So the first chunk there, key quote. So today was a closer call, but the right call. The market didn't like that because the futures market, Jeb, had priced in a 98.7% chance of a 25 basis point cut. And Powell, the first thing out of his mouth is, it was a close call. We didn't know if we were going to cut. So like, whew, we had it wrong. We've priced it a certain way, but we had it wrong. He says we're in a new phase in the process. The extent and timing language, which you just saw in the one that you just showed, shows we are at or near a point of slowing the rate cuts. So 90 days ago, the market is thinks, hey, we got a year and a half or 15 months of straight cuts. And they're saying we're kind of near pausing and stepping back. Significantly closer to neutral, but still restrictive. That's their way of saying we still think that future moves would be to cut versus hiking rates. So what do we talk about, Jeb? We talk about all the time. The two big things they're looking at are their dual mandate of price control, so keeping inflation, a lid on it, and then full employment. So on those two topics, for inflation, I see the inflation story as broadly on track. Might take another year or two from here to get to 2%, which they were hinting in the last few meetings that they thought we were on track for maybe 2% next year in 2025. Policymaker projections for policy rate are higher for next year, consistent with higher inflation, not things that anyone wants to hear. He's not saying it's going to the moon, he's saying we're not getting to the 2% that we want. Higher inflation is probably the biggest factor for the new projections. So the little dot plot that Jeb showed there early, the reason why those moved up is because they're seeing inflation higher than what they want to see, especially on the 90-day average when we look at the last 3 months. Unemployment, downside labor market risk appear to have diminished. So they're less worried about the labor market cooling, which is what led them to cut 50 basis points in September. And then we have to weigh a softer labor against sideways inflation. So they want to make sure that labor is propped up. They don't necessarily want to see a big spike in unemployment, but they also don't want to risk inflation. And the last one, Jeb, you and I have been talking a lot. We got a ton of questions on Trump's going to come in, he's going to put tariffs in place, and it's going to make inflation go to the moon. Powell's take on it is it's premature to make any conclusion on the impact of tariffs. Don't know what countries will be impacted, what size of tariffs, and how long they will impact us.
Good stuff. So again, a lot of not guessing, but a lot of projections, even from the Fed, as to what's going to happen with inflation, and that's why they're pricing it in. So the reality is, if the market delivers on inflation being higher, well, the market's kind of already should bake that in at the moment with where the Fed's mind is. If it comes in less, then the Fed maybe adjusts accordingly. If it comes in higher, then obviously has to adjust from there, right? So all of these things are projections going forward, but at the moment, what we're going to see going forward is, if it doesn't differentiate from where what we're seeing here, then again, it's already being baked into the Fed's cake, if you will. With that, we're going to go to where we normally start and talk about inventory, and from here, we'll dive into questions. So if you haven't done so already, let us know where you're watching from. Also, let us know what your questions are. We want to answer them. So the best thing to do is start putting them in now so that we can address them as soon as we come out. So single family homes, we actually fell this week to 681,000 unsold single family homes nationwide. We're up roughly 27% from last year with regards to unsold inventory for this time of the year. We went from 690 last week down to 682-ish, with, again, our peak being at 739. And for context, taking us back to 2015, we were just over a million fifty thousand homes on the market this time, compared to then. So about 60% of what we were back at that time. Orange County, we're still seeing inventory go down, which is normal. likely to continue through the end of the year, which again, at this point, is only about 2 weeks away. So Orange County sitting at 2,767 properties. That's single families, condos, townhomes, everything, which is down 5.38% week over week. And Huntington Beach down to 191, and that's down 4.71% week over week. Takes us to inventory here. Just another look at inventory, just showing the 1 year change in inventory across the United States from November of last year to November of this year. So you can see pretty much every state there has an increase for the most part, outside of like New York and some of the Northeast there, year over year increases. But here's the important chart is when we compare it to 2019, we still have a lot of negative numbers. There are some positive, Texas, Florida, some of those states that we've talked about, Arizona, a lot of the states where you've seen inventory obviously increase, but prices stall a little bit more are the ones that have seen the biggest increases in inventory.
That Northeast stuff is wild, Jeb. Is Maine the giant blob up there to the top right?
Yeah.
It was up 41% year over year, but still down 40%. How do you go up 40? They must have had like 3 houses for sale.
Yeah, it's all about
2022.
context, right? I mean, you don't know where they're coming from in these levels, but regardless, it still looks to be very, very competitive. New listings. So 45,000 new listings this week. That includes immediate sales, which are no longer on the market. We counted 7.7% more sellers than the same week a year ago. And then that takes us into new contracts pending. So new contracts pending, 47,000. Is that what it is? 47,000 single family homes. Is that right? 47,000 single family home sales started last week, averaging about 10% more home sales each week than 2023. And then that'll take us into home prices. So home prices, median price of new contracts sitting at 375. The recent average is about 384,000, which is 5% more than last year. And Housing Wire or Altos at the moment still forecasting 3.5% price gains in 2025, based off where we are at the moment, looking year over year. So it'll be.
They didn't watch CNBC today. Rates are going to go to like 9%, and no one's going to buy a house next year, so they're going to crash.
Well, I guess we'll see the update at some point. Price reductions: 38.2% of the market has some sort of price reduction. And that takes us into looking at this, Josh. So this comes from a newsletter that I get, an email that I get from actually another mortgage company.
Cheater.
I think he just aggregated the data himself, is what it looks like. But I thought it was an interesting chart to throw in here. And it just shows, again, the source and where they think rates will be at the end, of 2025. So fourth quarter of 2025. And you really have a range here, but it doesn't get much lower than somewhere in the 5s and much higher than low 7s. So which is essentially what we've been trending the last year and couple of months. So it looks to be a lot like 2024 in many ways when it comes to rates, but the theory is that the average will be lower because this year the average is going to come out about 6.7%, Josh.
A chunk of this, Jeb, is from the Resi Club chart. And I dug into the Resi Club article last night, and the really low numbers magically came out in October, right after that September cut when rates were still pretty low. So the more recent stuff is all thinking, mid 6s most of the year, low 6 by the end of the year. We're sitting here pushing 7% after all the action today. You and I had talked about, you get head fakes, Fed day, you get a lot of volatility, a lot of people not knowing exactly what's going on. Let's give it a couple days to shake out and see what happens.
No, exactly. It's going to take a little bit to work out the kinks, if you will. You guys always like to look at where rates are. This is unfortunately where rates are as of today. Josh, 30-year fixed hitting just over 7.1% on a 30-year, whereas FHA is coming in somewhere around 6.4, VA 6.4. Again, we always say if you're well qualified, you're probably going to be lower than these numbers. But just to give you an idea, I mean, we're up 20 basis points today, which considerable jump based off what happened in the market.
Yeah, I was kind of surprised to see it's up over 7. I was thinking 6.98 somewhere, just hanging on, but big spike today. And again, when you see a lot of volatility on a big move, a lot of times what lenders will do with their rate sheets is say, hey, we don't know what's coming next. We're not just going to price to where we're at. We're going to build in a little cushion in case we wake up tomorrow morning and they're running a little more.
Yeah, and again, a couple of months ago we saw interest rates come down. Fortunately, a lot of you guys took advantage of it because you needed to refinance. But at the same time, a lot of you didn't take advantage of it because you thought rates were going to move lower. And then all of a sudden now, hell, rates are a full percent higher, maybe even more in some cases than they were at that time. So it's important, like not trying to pick the top or the bottom here. Take the adjustments as they come down and do it again and again and again. Just do it with a no cost refinance. Don't get caught up into paying points and paying a bunch of closing costs. And because otherwise it makes it very difficult to do a refinance again if interest rates do come down. But with that, if you're interested in taking advantage of us, letting us watch rates for you so that if and when they come down, we can just reach out. The team can reach out. You can go to jebsmith.net/rate watch, and that will get you in touch with the team here, and we can watch rates for you. And there's all the places we can help. So with that, Josh, where would you like to go with the show this evening? Do we have any enlightening comments? Do we have anything positive in the comments? Because we need to start with positivity.
I don't know. I don't know
Nothing
there
positive.
are. So I don't know that we have a whole lot of positive, but we do have some questions. So we don't have a choice. We're going to jump in. So Ryan Pate from Arizona says, hi from Arizona. Will there be lower mortgage rates in 2025? So here, let's tie it to two questions here. Not this isn't really
lower
a question.
Than what?
So lower than where we're at today. Lower.
Well, I mean,
lower.
you could have asked. I mean, well, shit. I mean, excuse me. Depending on where we were this morning and where we are this afternoon, there's a 0.25% right there.
Well, here, Joe follows up with, you guys need to talk about the 10-year treasury, the huge jump today and where it was 15 basis points. That's not a huge jump. That's not even huge by big day moves. I mean, you've seen 25, 35 basis point moves
Josh,
in a single day, and where it's heading based on future auctions. We don't need to wait for auctions. The markets move every day. The auction is good or bad based on how the bidding falls relative to the when issued trading. The bond experts are calling for 5% within a few months and up to 6% in 2020. You were watching CNBC along with me and saw the clown show that they trotted out today, who wasn't saying anything about 5 or 6% treasury yields yesterday, but popped into that. So again, Jeb, you just showed an aggregation, a chart of really good forecasts throughout the next year. And there is a consensus. So back to the big question, will there be lower mortgage rates in 2025? Yeah, they're probably going to inch lower throughout the year. And now, if we say from 2022 to now, we've now seen 2.5 years of volatile and high interest rates, and we've had 3 windows of lower rates within that. So going back to what you were saying, Jeb, it's important to be nimble. It's important to work with a mortgage professional that knows how to advise you. There's not a right answer. What you think is the right answer is the right answer. But what I hear from a lot of people is, yeah, I keep talking to this guy and he keeps telling me I got to do a 2-1 buy down. I got to do a 3-2-1 buy down. It's like, well, do you want that? Do you understand what the benefit is? Do you need to do that? The one guy I was talking to didn't even need to. It can be the right tool, but temporary buy downs, permanent buy downs, the idea of spending as little as possible on your loan and coming back and refinancing when we get one of those windows, because I believe we'll continue to get these brief dips where you have 30, 60 days to take advantage. And, going back to one of our preferred sources, friend of the show, Logan Odeshami, he thinks in the next 12 months, the range is 5.75 to 7.25. You just showed we're at about 7 1/8. So it's hard and it takes some stones, but when you're near the top, you either float the interest rate if you're in process, or you don't spend a lot of money to buy a rate down, close on it, and know that we're likely to move at some point lower in that window and give you an opportunity.
Yeah, going back to the 10-year question, though, Josh, normally we do put a chart in there. Josh was at the dentist today. I put a lot of the charts in there because of Josh being absent, not sure when he was be back in the office. But Josh, if you have the ability to snap one real quick, screenshot one, let's throw it in there, because we did break out of the top of that channel on the 10-year, a longer trend line, going back to October of 2022, I think. I think that was the time that it broke out. Either way, I mean, that's not a good thing for the 10-year. It's not a good thing for rates, at least in the short term. But I mean, the question is, do we get confirmation tomorrow? Do we get confirmation over the next couple of days with a breakout, or does it come back in? And I think that's what's going to help us understand here. So if we take a look at that chart there, you can kind of see, yeah, I mean, your chart's actually drawn a little bit differently than mine. Whereas
yours
today,
yours doesn't look as bad. So we've poked out of it here back in the middle of November and then fell back within. This was a pretty big break, but again, started the day about 438 and ended 451. It's a 14 basis point move. I mean, we can point to 14 other candles here that had just as big of moves.
Yeah,
here's a day on the way
breakout
down
out of the trend, I think, is the biggest. The move, the 15 basis points or 10 or 5 or 50. It's the fact that, you know, it broke out. And I think that's what is the most important piece here.
You need a confirmation for a breakout. So tomorrow, Friday, are more important than what you would normally see, just to see if you get follow through or if you get some recovery back into the range. It will be hard to see a recovery back in the range. So we may get confirmation of that breakout.
Good stuff. So that will, you know, help in determining what the future looks like. So we will continue to talk about the 10-year and rates as we go on. But with that, Dina asked a question, says, are you guys optimistic for next year with housing market in general? Hope for first-time home buyers, ? Or hope for first-time home buyers. Asking the question, do I have hope? I think the market is going to be better for buyers than it has been over the last couple of years, personally speaking. And then the reason I believe that is because I think you're going to see more inventory come to the market. I think you're going to see slower price growth. And I do think you're going to see a lower average mortgage rate than we've seen the past 2 years. Overall. Now, it might not start January 1st. It's going to take some time for that to work down, but I do think it's a slower grind lower. So affordability is going to improve a little bit. Buyers are going to have more options. I don't think you're going to have that, you know, fighting over properties quite as much in this market. Real estate, I mean, you know, with real estate being local, 2025, the local where you are is going to have a bigger impact on your ability to purchase, you know, negotiate, all of those things than it's been over the last couple of years. The last couple of years, the entire United States has kind of been pretty strong. I think this coming year, it's going to be pockets that are a little bit stronger versus an overall overarching entire market. But we will see. In fact, Josh and I are recording our 2025 forecast tomorrow, and we're going to have this in a deep discussion, and that'll be coming out in a couple of weeks. So hopefully that helps. All right, Josh, what do we have here?
See what you like. They're all teed up.
Well, there's a lot of questions here just talking about, you know, Trump and Powell. I mean, it actually came from the same person. Just saying Trump is going to force Jay Powell out. Even though he cannot technically fire him, it will make it very uncomfortable and will bring the pressure. I don't think Jerome Powell cares.
I don't think he gives a shit either.
The guy is like, he's pretty steady. He's like steady Eddie. He's like, just says what it is and has very little emotion or expression or what have you. And, you know, Trump does feel like he should have an opinion on this whole thing. He's been very clear about that and vocal about it. But at the end of the day, he doesn't have any true impact on it other than if he can pressure Jerome Powell in some way. But at the end of the day, there's 15
in what way? It's not, this isn't the mafia. You don't get to send your goons over to beat him up on the way to his car. Like there's,
sure,
he can do as much as he wants publicly, but you saw going back to his first term, he beat him up real good in the press, and that's about as much as he can do. Powell does not care.
Sure. Yeah, and we'll see, right? But at the end of the day, the predictions are out there at the moment with what the Fed is going to do. So, you know, the transparency we've talked about it many times is going to be kind of the key in you know what happens, because it's out there, right? So at this point, if the Fed cuts 2 times in 2025, there shouldn't be any real changes in much lower rates or much higher rates, it's kind of as expected. If you see the Fed cut more than 2 times, well, you're going to see that impacted in rates. More than 2 times or less than 2 times, that's going to be impacted on the other side. So again, it's one meeting and we're fresh off this thing. So the headlines are crazy at the moment. We need a couple days for things.
I compare it to this, Jeb, when you're watching the World Series or the NBA Finals, and 2 games in, one team is just clobbering them, and so the experts are on. And they're like, "Well, they're just too big. They're too fast. This offense is too much. They're too good at 3-point shooting." And then they lose the next 2 games, and they come back. Well, these guys are just they can't compete. It's like just back and forth. It's like ping pong, and the experts come out with their confirmation bias, whatever they saw the last game or 2, and that's what we're seeing. We saw a decisive victory for the Bulls in September, the Bond Bulls, not the Chicago Bulls. And then today, the Bears are all out with really strong opinions about how right they are and that rates are shooting to the moon.
Interesting question here. Are these cuts for people to give up? Basically, are these cuts enough for people to give up their 3%, 4%, or 5% interest rates? And my response is the cuts have nothing to do with people giving up their rate at this point, right? The idea is that what determines whether somebody will give up a rate, and it really comes down to payment, whether the house still works, a lot of these different factors. But I can tell you from personal conversations I'm having as an agent in just a small market here, that people are getting more okay with giving up their lower interest rate for a higher interest rate. They've seen rates climb for the last couple of years. I think they've become adjusted mentally to like, hey, maybe rates aren't going to go back down to where I have my rate. And I can't do this anymore with this house because I've got too many kids and too little space, or this house just doesn't work for what we wanted. We bought it too quickly without thinking about this or that or what have you. So what I would say is that I think you're going to see more inventory this year from people that are willing to give up their 3%, 4%, 5% interest rate, 2%, whatever. And I think it's just a progression in the market. People they need a change, they want to change, and they're becoming more accustomed to higher rates. They might not like it, but more people are going to be willing to give it up in 2025. Does that mean inventory is going to shoot through the moon? I don't think so. But Housing Wire is one of the outlets that we follow. They're thinking somewhere between it's either Altos or Housing Wire, one and the same, I think, at this point, because they own them. But they're thinking about a 15% increase in inventory next year, which means I think our peak this year was about 740,000 homes. So add about another 100,000 or so to that. So mid 800,000 on total inventory next year. We'll see.
We have a comment. Fatak, I thought it was Photok. Fatak says Trump opposed the CR. Maybe that caused stock market collapse. So early in the day, Elon came out and said he thinks it's a bad compromise, and then Trump threw his hat behind in that. And it certainly could. That can shake up the markets, and it can cause a pop in yields on a day when they were already prone to pop. Could have exacerbated it. So if we find ourselves next Wednesday back within the range, I would give more credence to this.
Good stuff. 007 here asking if they said they locked in an FHA streamline at 5.75 until January 9th. Should I wait to see if rates go down? These are the questions that I'm talking about. People move forward. Like, stop trying to pick the top or the bottom in rates. If take the rate, it would be my suggestion, right? It's rates are about 0.5% higher than that today, probably.
Jeb, here's an interesting thing. We've had this with multiple listeners, but have one that we're going through this with right now. No sense of urgency whatsoever. They had a 2 1/8% savings on the table with a no-cost loan on $1 million loan. You take that, you close it, and you move on. But there's real world reasons why they didn't. But what I often get is I want to shop. I'm going to talk to this person. I'm going to talk to that person. By the time they circle back and go, okay, you had the best rate. Well, that's not what the rate is any longer. What we've seen over the last 2.5 years, these windows are short. So we had popped back up to this level, a month ago, and then we got another reprieve where they came back down about 0.5%. And we have a bunch of people that were like, awesome, get me locked in, let's do this. But the folks that never really looked around 3 months ago and never really missed that window, they're still not getting the message that, like, if you can do a no-cost loan and knock $200, $300, $400, $500 off your payment, do it and look to do it again. If you're looking at paying a point to get that down, so you got $3,000 in closing costs, you got $4,000 in points, you're adding $7,000 to your loan. Maybe we need to think about that. But when you have low and no-cost loans, 0 points, no cost, take the money and run. It's hurting my heart watching people overthink this and leave lots of money on the table.
Yeah. And here's what I guarantee is going to happen, Josh. Guaranteed. Put money on the table right now. We can make a bet. You're going to get calls tomorrow from people that were told that they should not lock their rate prior to the Fed announcement because the Fed's going to cut 25 basis points. And these people are going to have a higher quoted rate, and they're going to reach out and ask you if you can compete with it. What do you think?
Jeb, I had someone 2 weeks ago say, okay, yeah, we're talking with our bank also, but they told us do not lock until the 18th because the Fed's going to lower interest rates. And I said, if you talk to anyone that does mortgages and says something that's stupid, slap them, turn around and walk away, because they don't understand how the market works, and they shouldn't be within a million miles of advising anyone on something as big as a mortgage.
All right. Mortgage rate predictions for next year are like marriages from reality shows. Unpredictable. Josh, I don't really think that's that unpredictable.
Unpredictable and likely to end in tears. They didn't close the thought.
I think it's pretty predictable of what's going to happen with those marriages from reality shows. Unlike interest rates at the moment, no idea where they're going. Josh, what we answered that one already. What do we have here? If you see something, put it on there. I'm having trouble with my screen.
Well, here's an interesting one that we don't get all that often. What are the average fees for a HELOC? People reach out all the time. Hey, can you do a HELOC? Yes, we absolutely can. The fees are all over the place. Hopefully you're doing them 0 points. Some of banks and credit unions are going to have most likely an option for you to do it at no cost. And with that, they're going to have a tighter box. So the more where you need a broker on a HELOC is if you're just outside. You're like 12. You're 12, Jeb.
I was going to repeat it, but then I thought that
I'm
would
like, why is this idiot laughing while I'm trying to tell people?
That would be too much if I just repeated that.
So
I didn't repeat it. Instead, I just laughed.
Will this make you happier, Jeb? You'll have looser guidelines if you go to a broker. They will let you get away with more. So it just depends on what you need. If you're extremely well qualified, you're not going to a high loan to value, you can probably get it at no cost to a bank. If you need we're going to shut the show down early. We've gone 34 minutes and Jeb's 12 and can't stop laughing.
That's great.
All right.
It's like being in church. Remember ever being in church and somebody said something and then you knew you weren't supposed to laugh, which made it even funnier. And then you're sitting there and you're like just about to bust and you can't figure out and then all of a sudden one of you just loses it and it's dead silence.
So you'll actually like this. My dad was a pastor when I was little, and I remember being about 5 years old, and my brother is over flirting with some girl. He's 6 years old, so he's like 11 or 12, flirting with some girl, and they're playing footsies or whatever. And my dad called him out right from the pulpit, told him to get up and move to the other side of the church. It's a small church, like 200 people in there. But in front of 200 people, my brother had to get up and walk away from his little girlfriend that he was farting around with.
And that's classic. Yeah. Too good. All right. We have no questions, Josh. So what is it that you would like to discuss right now?
Fart coin. We're going to ask a question. Do any of you own fart coin, and have you benefited from the 60,000% run up over the last month in fart coin value? That's a
serious question.
To say value in fart coin.
Serious question. Let's hear it. Okay. Willing is asking, is the definition of a primary residence hazy? No, it's an occupant. It's a It's a residence that you're going to occupy as your primary home. So where are you going to have your mail sent? Where are you going to have your utilities turned on? That would make your primary home. So it's not hazy by any means. With that said, definitely people do say, yes, I'm going to live there. Don't make it a rental, all of those sort of things. But as far as the guidelines go, it needs to be a home that you're going to occupy.
Well, here, this one actually, he gave some clarification. Borrower currently renting but wants to buy a house out of state. Can that be considered a primary residence? Will eventually live there full time as a primary, but it might be a couple of years. Must this be done as an investment at 25% down? Investment or second home, because it is not going to be their primary residence. Primary residence, what, we got 365 days in a year. Are you there 183, 184 days out of the year? If not, it's not your primary residence. So it is the home that goes on your tax return that you spend the majority of your time at. So the fact that you're a renter or that you're somewhere else doesn't change that fact. And even if, so I have people a lot of the time say, well, no, I'm going out there, I'm going to move. Okay, well, cool. If your job is here, we need a letter from your employer that says you're going to be able to work remotely, or we can't use the current employment to qualify for it.
Good stuff. All right. So I highlighted everything on my screen somehow. Closing on a new build in early February. The rate is not looking good. Yeah, at the moment it's not. Hard to say, right? So February, a lot of time between now and then, 2 months, if you will. So, or depending on when you're closing in February, 2 months. So there's time for the market to settle down. If I were a betting man, I do think rates will settle down between now and then. I don't think you're going to see much higher from here. I think the market probably, in my opinion, the peak is kind of here at the moment. I think there's nothing data wise that should come out, within, I don't know, next couple of weeks that should change the market's direction as a whole, right? So you had the worst of what the Fed said today. Powell came out. You got the Fed predictions. We just had CPI last week. The data's there. Jobless claims last week were worse than expected. We don't have another jobs report for 2 weeks. So I think the market threw up everything it needed to get out, right? So to me, that's the high side of this. Could I be wrong? Absolutely. That doesn't mean you should wait until February, but what I would say is that, fortunately, you're new construction, so hopefully there's some incentive from that side that's allowing you to get a lower rate.
You know what we haven't heard about a lot, Jeb? In the early going of rates spiking, builders were very wary of fallout when rates spike. So they would say, hey, we'll eat the cost of a 270-day lock, 180-day lock for you, and you have a one-time opportunity to float down. It would be worth asking if they offer the float down. We haven't heard of it a lot, so doubtful that it's being offered, but it was in the early going of all this. Jeb, Mina, a VIP listener, is here with an excellent question. Do you think it's worth it to switch to a biweekly mortgage payment or make one extra mortgage payment a year? Here's the important thing to remember. What were you going to say, Jeb? And then I'll go where I'm going to go, because
I would say, I don't necessarily like the biweekly piece of it. I like the idea of just paying extra, towards the principal and however you want to do it every month. Most of the online accounts now have a place for you to make your payment and then an additional spot that says additional principal, and you can just divide it and pay it however you want. That's how I would do it personally. But I do think it could be worth it. I mean, where rates are today, depending on what your rate is, you're probably knocking 4 or 5 years off your mortgage, with just one extra payment, which is a considerable amount of interest.
I'm going to co-sign what you said, Jeb. The idea of a biweekly mortgage, like literally when I started in the 90s, when your loan closed and the deed recorded, you get a bunch of things in the mail of these companies saying, hey, we'll do a biweekly mortgage for you. You make the payment to us and we're going to do this. It's archaic because it was pre-internet, essentially. So now with the internet, I would say the most common question that I get when we're closing someone's loan is, when do I get access to the portal? And how do I set up my auto payment? Most people like auto payment, or at least going online and making their payment. no one writes checks anymore. Like millennials, like, what in the hell's a check, old man? And like, I've hated checks from the day I was born and was happy to see them die. But it's really from that era. So you can go in, if you set up an auto payment, you can say, I want $100 extra a month to go. I want $500 extra a month to go. So, jump into a mortgage calculator and figure out with your loan balance, your interest rate, what you're trying to accomplish. Do I want to cut 2 years off of it? Do I want to cut 10 years off of it? Figure out what that payment is and set it up. And you can change it. If you want to increase that extra principal payment, decrease it at any point. I don't think that whole idea of once a year making an extra payment or doing the biweekly is necessary. Figure out what you're trying to accomplish or how much extra you have and set it up in the portal.
Good stuff. Good stuff. Question coming in says, I accidentally, is it on the screen there? I can't see. Yeah, no. Somehow it was a property survey question, Josh, and I
think I know where it is. Boom, I got it.
There you go.
LT Gemini. Is that Lieutenant Gemini or is it LT Gemini? I don't know. Could a property line marked by a surveyor be incorrect, Mr. Jeb?
I guess anything could be incorrect. My guess is it's probably not. Again, well, that's just me outside looking in, right? So these guys have fancy equipment to survey these lines, and typically they're measuring it off other boundaries, and it's not just one line they're measuring. It's, there's a site that they're shooting further down in most cases. So could it be? Sure. Is it likely? I don't know. I would say I would lean toward no. But I guess it's a better question is, why are you asking it, right? Do you think something's off with the line? If so, you can call the city and try to have them come out. If you want your own surveyor, surveying can be very, very expensive depending on where you're located. Here in California, it's $4,000 or $5,000, I think, minimum probably, to have somebody come out and survey a lot. So depending on where you are, it might be less expensive, but could be worth it depending on what you're trying to accomplish.
Interesting, Josh, trivia. My mom's neighbor in Indianapolis, the surveying pins are in between their yard, and the old man actually just passed away a week or two ago, but he was very angry.
Your mom went and moved them.
No, he would come out and take the pins down and throw them in our yard or my mom's yard, because he was mad at where the surveyor actually placed them. So the surveyor did his job accurately, but the old man would come out and move them or throw them in the yard and all sorts of things.
Too funny. Josh, can you answer this question or confirm this or not right now? One extra payment a year can shave 4 years off.
It's always going to depend on the interest rate.
Yeah, it depends on the rate. If rates are about 6%, it's about 4 years, I think. If I remember,
it sounds about right, but it's always going to depend on the interest rate. The higher the interest rate, the more it shaves off.
There you go. Okay, good stuff. Hit something there, John.
So Willing has sort of a follow-up to that last question. If you're renting and you want to buy a home, can you use a second home even though you technically don't own a home? You absolutely can, because, hey, my primary residence, here I rent. I will buy that as a second home, assuming you qualify for your rent and that payment. But the problem is Fannie Freddie changed their guidelines a few years ago. They're priced identical to an investment property. So unless you have a portfolio lender, a non-QM lender that has better pricing, you're still looking at the same terrible non-owner pricing.
Good. Question, Josh, can you change an investment loan to an owner-occupied loan at a later time?
The loan is permanent. It is not going to be changed. You can change out the loan. You can swap out the loan, but you cannot change the loan. So if you get an owner-occupied loan, it's never going to become, or an investment property loan, it's never going to become owner-occupied. But when you go to refi, if you moved into an investment property that was financed as an investment property, you can absolutely refinance it as a residence as long as it is now currently your residence.
Well, Josh, I just got a message from one of the agents that we referred the Sinclairs up to in Northern California. And I was looking at my text or email coming in.
Recording confirmation?
She got recording confirmation. So they closed today. So I don't know if they watched this show. You would know better than I do because you had multiple conversations with him.
I think he listens, so he'll hear the recording on Friday.
All right. Well, congratulations, Jim and Cheryl. Is it Jim and Cheryl? Cheryl. Yeah, congratulations on your new home up in the Sacramento market. So that's awesome.
You guys, Jim, you have something to aspire to as a listener, because Jim told us he found us about 3.5 months ago and had listened to about 60 hours of the podcast. So if any of you want to break his Guinness Book of World Records, much better than that young lady's Guinness Book of World Records she's trying to break. So spend your hours listening to the Educated Homebuyer podcast.
There you go. Drew's coming in, dropping some knowledge here on surveys. Just basically says you have to use the actual survey itself, not the marking on a tree. Very true. But a lot of times people, you can't use the survey itself without knowing where some of the markings are, right? So we have, with our title reports, we have like a plat map that shows the boundaries of the lots. But the problem is nobody truly knows where those, corners, if you will, are to measure back and across and what have you. So it's helpful for actually having the markings. But then he follows up and says you could also try to locate the rebar in the ground with a magnet at the corners of the lot. So I'm not sure if that's something they do on every lot. Why would there be rebar in the corners?
Sounds like something they do in Kinston. I don't know.
Yeah, I don't know. I don't know about the rebar in the corners. That would only if there was a fence there or something, there would be rebar in the corner. But anyhow, I don't know. Maybe that's a thing. I'm not a up to date, an astute surveyor by any means. Obnoxious Bronco says, can someone use an I-10 number to qualify to buy a home in the state of Arizona, Josh? Or just say any state for that matter.
Any state. So yeah, the answer is yes, anywhere. Can they do it in Arizona? Yes, because they can do it anywhere. You're looking at, it's sort of like a non-QM loan. It is a type of non-QM loan. You're going to pay a higher interest rate and generally have to put a larger down payment, but can you do it? You can absolutely do it.
All right. Interesting question here. Going to be very difficult to truly get a solid answer on this, but it's something we could talk about because I don't know that we've ever actually had this conversation, Josh. What questions should you ask with new build communities regarding outlook and what impacts HOA fees? So, Josh, a lot of times when you go buy new construction, there's a preliminary budget set up for the community, right? What they think, because it's new. You don't have, maintenance, but you do have a reserve that you got to start putting money in and things that you got to maintain and that sort of thing. So there's a preliminary budget coming in, which in theory is probably intact until you actually get the board of directors and the community formed, at which point I guess the HOA fees could change. But as far as an outlook goes, what impacts it? Essentially everything, right? Cost to, for landscaping, for any sort of maintenance, that sort of thing. You also have to start you got to get an actuary study where you start putting money into reserves based on the life of things, right? So you're going to have this idea of, when roofs need to be replaced, when properties need to be painted, streets need to be replaced, all of that stuff. And then you start allocating money to those so that when the time is right, there's money in those accounts. Now, all communities are different. Some HOAs cover these things. Some HOAs do not. So it's going to there's a lot going on with this question. And honestly, new build communities are probably not going to be able to give you really any information at all as to the direction of the HOA.
Jeb, did I tell you about my client that bought 2 horizontal property regime properties in
Tennessee?
Nashville?
Yes, you did.
So it was new build. And it was all in the CCNRs that once all 4 units, a 4-unit building, all 4 were sold, they would get together and figure out what budget was required and what the HOA dues would be. I'm like, you're buying a house and you don't have any idea of what it's going to be. It was written in those CCNRs that this is the max that it could be. So with that, we had to use that max figure for qualifying them. But I was looking at there's no world in which I'm buying a property where I don't know for a fact what my HOA fees are going to be and what it's going to cover and all that fun stuff.
Well, here's the deal, Josh. If we ever have a surveying question going forward, I'm going to ask.
We're calling Drew.
I'm calling Drew. Drew clearly knows what's going on here. It just says the surveyor will locate the corners of a lot with a piece of steel in the ground with a plastic cap that is associated with their license. There you go. That is, I can't even argue that. I know nothing about surveying.
What if Drew was just sitting at home making things up and saying, what if I could
Maybe
put the craziest comment
GPT.
ever and just see if they would read it?
Yeah. I mean, I'll go with that. It sounds reasonable to me that, and you seem confident in your response. So I'm going to go with it. This is how rumors start, by the way.
Yes,
Josh.
Yes.
By a comment, then I just say that's fact. And I'm going to start repeating that now. When people say it, I'm going I'm actually going to say what you say, so I sound
I
smart.
heard it on the internet. It has to be
Yeah.
true.
And it's going to be good. How do you determine an offer price for a light fixer that has been on the market for 3 months? So, Josh, you've fixed and flipped properties. How do you determine a price, right? So, what I could tell you is the overarching view of this is that you determine the after repair value of the property. Like, what is the property going to be worth once it's repaired? And then you got to back your way into it and figure out your numbers. And then you got to leave yourself some room for profit if you're trying to flip it, Josh. But
Well,
how do you
profit if you're
determine?
trying to flip it, but to make it worth your while, if you're not. And some of this, so again, I don't want to do extra work. If I could go buy a house that's dialed in over here, or I can go buy this one for a $25,000 discount and do $25,000 worth of work and have the same house, I would go buy the one that's already done. I want some reward for my work, even if I'm not going to flip it. So that's an important concept. And then you got to weigh that as to where we're at in the market. So the perfect time, I'll tell people, in 2008, banks had so many homes that they were like, there were 5 investors in Orange County, and if we accidentally wrote the same offer on the same property, we would just go, no, take that, I'll go right on that one. I don't care. There were too many houses, so the discounts were huge. Contrast that with 2021, when the discounts were tiny. You would have a house that needed $75,000 worth of work that would sell for a $25,000 discount because there were so many people wanting it. So your situation here, it's that market dynamic. So it's been on the market for 3 months. We don't have people beating down their door to buy it. So it goes back to that same thing. Is the seller unreasonable? Are they willing to accept what the real number is that someone is willing to take on this project and want to build in a cushion of some sweat equity?
Okay, here's where I would rebut what you just said. The fact
You're
that a
wrong.
property's been
You're
on
wrong. I don't even know what you said, but you're wrong.
the fact that a property's been on the market for 3 months means nothing, because you don't know what's going on behind the scenes. For example, I have a property right now that's a flip property. You look at days on market, you think he's desperate, he's got to do something. That's not the case at all. I've got more offers than I know what to do with. The problem is there's things happening behind the scenes with family and decisions and just everything. So there's a lot more going on than you just see surface level. So just before you think, oh, it's been on the three months, I've got the upper hand. Have a conversation and figure out why. Have they had any offers? Do they have any offers? What is keeping the seller from making a decision first off, and then back your way into it.
And that's the conversation that your realtor is going to have. That's the value of a good realtor, is reaching out and trying to, because both sides, the value of a good realtor, your realtor is trying to uncover those facts, and their realtor is trying to portray a strong hand that, no, we've got multiple offers, or, oh, he's just been busy. He's been vacationing in the Maldives. He was not ready to accept an offer.
My client has not been vacationing in the Maldives.
But you know what I'm saying? That's that game of poker that both of
Sure.
the agents are doing. They want to represent a strong hand. You want to find out if there's any weakness, but it's still, you're going to determine your numbers and what it's worth to you, and then see if you can match that up to wherever that seller is.
And here comes Drew. Drew just one-upped us again. A little loan officer over here, a little mortgage guy comes in with the engineer stamp. So Drew, we can trust Drew now. Drew's an engineer. So
if we need some house plans when next time we're flipping,
we're going to take Drew for his word.
Can we get Drew's engineer stamp on there that this is all good plans?
We're gonna take his word for it. Now we trust in Drew in all things surveying going forward. So he's our guy. LT. I don't know what this acronym stands for. Josh, can you help me out?
Follow up. It's following up. It's a follow-up question.
Oh, follow up. Jeez, makes sense now that I look at it like that. I thought they were talking to somebody up in the chat initially.
Flow up. Who's flow up?
Anyway, it says, I paid for a surveyor since moving in. My neighbor thought she had more room at her existing flower bed, as her existing flower bed are over the line. I left the visible marks in the ground and removed the overgrowth. So, yeah, assuming those lines were correct, you were good to go. But did you look in the ground or find the rebar is what I want to know.
Jeb, Marcus had a little bit of follow-up saying, I want to buy a house as a fixer. I'm not a flipper. But I would still say, I mean, if you are willing to do $25,000 worth of work for a $25,000 discount and not receive any gain from that, totally good call, personal call. For me, if I'm going to do that, I want some return on my money. Other than if you say, like, if you go to a neighborhood and you're like, hey, two similar homes are for sale and I can pay full price for one done to someone else's taste, maybe the payoff or the reward for me is that light fixture. I get to make some of it to my taste. Personal call, whatever you want in value.
Good. John, have locked in a rate for an investment property. However, if I decide to pay cash, will there be any issues with the lender? No issues at all. Just make sure your lender knows that you're moving forward with cash, but there's no issue there. Something interesting. I got an email today from Reports on Housing, which is one of the newsletters that we subscribe to locally here, Josh, with Orange County data, and they reported that 23% of the sales from January through November of this year were cash. So 23%. It's almost a fourth of the sales in our market were cash this year. So guess what doesn't affect those people? Interest rates. So, it'll be interesting going forward. I don't think that number is going to be any less going forward. I think there's a lot of people still out there with cash. So it'll be interesting. We will see. We will see.
We will see.
Do I think it's a risky time to flip houses right now? I do think it's a risky time, depending on your market. Some markets are still tried and true, and you're probably going to be okay. Here's the thing. At the right price, doesn't matter what market you're in. But what I will say at the same time, it's probably the most cautious that flippers should be, investors should be over the last couple of years, just because you do have kind of a changing dynamic in the market. And so prices everything. Orange County. Yeah, I think it's a solid market at the right price. But I see a lot of flippers out there paying numbers that I don't know how they're getting away with them.
Well, Jeb, let's go back to that 2008 time machine. We were buying homes in Anaheim in the low 200s, 220, 240. They needed $50,000, which would, at that time, prices were way less for labor and materials. You could do everything: windows, roof, kitchens, baths, flooring, doors, molding, everything. You're into them for $3. They were worth about $4 when they were done. So I have to 240 to get into it, 50 to 60 to carry it. I got 300 invested. I make 400 when I sell it. Take away your selling costs. You got 60, 70, $80,000 of profit on a $300,000 investment, and you're in and out in 3 to 4 months. That's a really nice annualized rate of return. Now let's flash forward. That same house, lucky to buy it for 700. It's about 125. If I need to do all of the same work, I'm into it for 825, and it probably sells for low nines. I got $100,000.
That thing at 700,000. Well, I mean, that's the thing, right? I mean, I guess you could.
That same market in Anaheim, 3-1, 3-2, distressed, that needs all of that same
super
work.
Distressed. Yeah, exactly.
That same property. And but now, so look at the same situation. I paid 7 something for it. I carried it for 3 to 4 months, which is expensive, and then I put 125,000. I'm gonna do it for 850, and I might make the same $50,000 or $60,000 at the end of the day. So the risk is much higher. The other thing I would say, we had an investor that financed a lot of the deals that we did, and his take is, I'll loan you 100% plus the cost to repair it, because I don't care if I get to own that house for $300,000. I just got a sweet little investment that I can rent out, and it's going to break even for my $300,000. So what my mortgage is, someone will rent for it. That's not even close to the case now. If you got $800,000 into a property, you're going to have a $7,000 or $8,000 a month payment for something that rents for $4,000 a month. So is it risky? The risk is much higher, and the rewards are much lower on a percentage annualized ROI basis.
Okay, good stuff. And agreed. Rents have a lot to do with it. I mean, rents aren't even, rents are high, but not anywhere close to covering what a mortgage would be on something like that, compared to where it was back when Josh was flipping. Drew just says, I don't have the stamp just yet, gentlemen. However, I'm very close.
Keep it posted.
Yes. Yeah. We want to know. We need to know if we have an in-house surveyor here, on the books. So we're on retainer.
So Jeff, this one's actually been up here for a while. Let's get this answered. Any tips for someone that just got a new job a few months ago that's 1099 and doesn't want to get a cosigner, struggling to be approved for a loan? There aren't a lot of options other than doing bank statement loan, non-QM loan, which will require a big down payment and a much higher interest rate. So a cosigner would be vastly preferable in that situation. There's really no two ways around it. Depending on the loan program, you're going to need at least 1 solid year up to 2 full years of that self-employment. The reason being is 1099 income, that's your gross. That's what you're getting paid, but there's no withholdings. You assume the lender is assuming there's overhead, and they don't know what that overhead is. So could you make 90% of the gross, take that to the net? It might be 30, 40%. So until they have at least probably a 2-year history, there's not going to be any way around it. There's no magic out there other than non-QM loans, bank statement loans, some of that type of stuff, which
you could claim more on your taxes than you make, which isn't a
it
good
doesn't have
idea.
history. It went to being 1099, so it doesn't matter. You can put anything
Oh,
you
if
want.
you don't have the business,
You don't have the history of it.
Got it. Yeah. So that's not good. You shouldn't do that anyway. That would suck. But yeah, not a lot of options.
The reality is, Jeb, the people that do that, every spring I deal with 3 or 4 business owners that do that. Hey, want to buy a house? Look at my rough tax return. Do I qualify, or do I need to take less deductions? Are they screwing the lender and lying and saying that they don't qualify? No, they're doing that to the government every year when they're itemizing a million things that they're not made up. They're not cooking the books to just put things on the tax return, but they're taking every deduction under the sun, some of them probably questionable, and you back those off, and then now they qualify for a home.
All right, a couple questions. We're here at an hour, but we're going to get to these real quick. Or just one's a comment. Ray of Sunshine said, kudos to you both. Our home on the market in early spring, sold by the beginning of summer, closed on new property at the same time. The closing on the sale was nail biting, but your channel helped us both. So with that said, we appreciate you. We appreciate you listening, using, us as you see fit. And hopefully we guided you to the finish line successfully. Well, we did successfully, I guess, but hopefully it was everything that you had hoped it would be. Josh, your cousin's here. Joe, looking to purchase a mixed use rather than lease for my business. 2 residential units are already occupied. I'll be occupying the commercial. How should I finance it? How do you finance something like that, Josh?
Goes back to some of Willing's questions. So as long as it's 51% or more residential, you can get residential financing on it, but it is going to be an investment, even though you're going to be owner occupying the commercial space. It's funny, as I say that out loud, I'm losing my confidence that is accurate. You're not occupying it as your residence, so my gut would be that it's going to be non-owner. You're not going to be able to go in and do like a 3.5% down FHA, which FHA would do that if you have 2 units of rental and 1 of commercial, if you're going to live in one of those units. With you not living on site, if you're doing residential financing, I think it's going to be non-owner. But don't quote me on that. I would have to dig into the guidelines. We actually had a listener from, I think it was Ohio or Pennsylvania, reached out about 3-4 months ago. They had the exact same situation, 3-unit building, 1 commercial, 2 residential. They had the 2 residential rented out, and they were looking to refinance the entire building because they used the commercial for their own business.
Got it. So he just confirmed what you said there. So thanks, guys, for listening. Next week's Christmas, as you guys know, on Wednesday. So we're not going to be here on Christmas night. We are trying to figure out what the show looks like next week. We're trying to get in either an update on the economy like we do at the beginning of the show, and or some sort of Q&A that we'll put out either on Wednesday night at the same time, and you can watch it when you want, or maybe we come on Monday. We don't know for certain at the moment. So what I would say is, if you're interested at all, just pay attention to the channel. We'll update it. And if you need something specifically, you can reach out, question, just using the chat there, or you can use the link scrolling at the bottom, jebsmith.net/referral. That'll get you in touch with Josh, myself, if we can be of any assistance to you. We wish you a Merry Christmas.
And a Happy New Year.
Yeah, I almost started singing there. We're very grateful that you guys show up every week. Hopefully we can be of assistance to you moving forward in 2025. We're here if you need us. But until next time, Josh, adios.
Amigos.